Crypto takes what do you do if you're making money and what you should do if you're losing money. So crypto tanks becomes pretty important for you to know what's happening and what you should do, how you should report your income. Recently in Tax Information Bulletin released just last month, IRD has issued some guidelines and there is a decision on one tax case as well. They have published it. This might help you to understand the crypto tax and what is their guideline and what are they thinking in terms of crypto tax. So what it is, I'll try to explain you. IRD treats many transactions as taxable. So this is what their view is. It is still a taxable income and they are really increasing their focuses on all those exchanges, trying to get information from these exchange servers and trying to do some manipulation, some data crunching and trying to get into some nitty-gritty of the taxation themselves. They have highly robust softwares and that can do a lot of analysis and can pick up some data of people and then automatically send them an emails and get that information. So if you have some concerns on that, I highly recommend go and seek tax advisor and get something. But today I'll give you some introduction to crypto tax and what that it means. This is a property, not a currency. This is what IRD view is. Gains often considered income, not capital. This is what they have mentioned. And they also look at your intent and behavior. So these lot of things matter when the tax is calculated. Now, what is crypto activities? So what get into a taxation or not? Selling or swapping crypto. One. Second, converting this to a currency, New Zealand dollar or any other foreign currency. If you're converting, this is also classified as income. Staking rewards. If you're doing staking, you get some rewards. This is your income. Airdrops in many cases. Yield farming and lending, receiving interest is your income. Mining income, buying and selling NFTs for profit. This is what they have classified. Now, look at what is not your income. If you're just transacting between your accounts, account A to account B, there is not your income. And if you're just moving from one exchange to another, that's not. And if you're holding just crypto, not selling it. So basically not much activity, then this is not your income. Now this is a TDS 2523 tax treatment of crypto assets, disposal, staking and rewards. So this is what they have mentioned. Now in this specific case, what happened, taxpayers knew or they did not know, I don't know who the tax advisor was. What they did, they put the tax returns to the commissioner. Correct tax return. They said, okay, these my tax returns are IRD, you take these tax returns, so these are the correct returns. They put it to IRD. Then what they did, oh, stop it, let me change my tax returns. So I change my tax returns, they're saying, no, give it money back to me, give the tax I'm about to pay you, give it back to me because this is not my income. Now this is a very common, when I was studying taxation with my colleagues, this was the term they used to use. So do the right thing, put everything to the commissioner and then you change it, put a NOPA that we like to change it, notice of proposed adjustments. So this will basically eliminate any risk attached to your income and any reporting. So this is what exactly they have done in this case. But however, once IRD know they're gonna get millions of dollars of tax or hundreds of thousands, I don't know the exact amounts, that's not published in the case. But if IRD know this is what I'm going to receive and all of a sudden they get to know, oh, I need to pay this money back, they're gonna say, no, stop it. According to me, this wasn't a good structure what they put through. But however, this case outlined this section, CB4, acquiring for the purpose of disposal, profit making intention or scheme, CB3, and income under ordinary concept, CA1, subsection 2. So CB3, CB4, CA1, subsection 2 were clearly discussed in this case. So what happened? The tax council found out, yes, CB4 apply. Taxpayer could not prove that that their dominant purpose for acquiring crypto was long-term income. The taxpayer could not prove that the pattern of buying, dips, selling, and reinvesting for similar returns indicated a dominant purpose of disposal. So dominant purpose was discussed and they could not identify that it's a long-term income. Dominant purpose was disposal. That's why Tax Council said, yes, CB4 apply. CB3 was discussed in detail. Their behavior showed a coherent plan involving acquiring, accumulating, staking, and selling crypto for profit. It's like a business that was a profit-making intention and a scheme. CB3 applied. So basically in this case, the discussions and arguments what Income Tax Act 2007 has were discussed and put through. So this case becomes very important from the tax planning point of view, what one should do when they are disclosing their income or not disclosing their income. They also said CA1 subsection 2, income under ordinary concept also apply. Staking rewards were regular, convertible to money and represented a return on the staked assets. Therefore, they were income under ordinary concepts. All those rewards were also income under ordinary concepts. So these things were discussed. Now, also look at staking, rewards, and yield farming. All these are treated as income when received. Taxed at NZD market value on receipt. Now, this is I'm talking about New Zealand context. You might be in different country, but same kind of rules might apply there. You will convert that to your local currency and then you will look at staking rewards, yield farming and things like that for your income tax calculation purposes. Mining income was also discussed. When mining is done in a large scale, that's business in nature. If mining is done small scale, this could be personal income. This taxes to be paid. Expenses may be deductible if you are doing mining. NFTs also taxable if purchased to resell. Taxable if created, minted for sale. Same principles as other crypto assets will also apply to NFTs. Records, what you should do, you should keep the records for minimum of 7 years. You should look at these things. Exchange transaction history, wallet logs and addresses, buy and sell dates, staking, mining rewards logs, fees paid, market value at time of transaction, and what conversion you are using to foreign currency. So these things becomes important. Keep the records for at least 7 years because it can be asked on demand. How to calculate your taxes? Basically, we do not have separate capital gain tax as such. So income tax on profit under ordinary concept will apply, which is profit is equal to sale price minus purchase cost, and any rewards that you have received at market value to be calculated and to be also included here. Methods to be used, first in, first out, or specific methods which are accepted by the commissioner. Common mistakes, what people think that has happened over the years, and this is what IRD published it, is mixing personal and business crypto, not tracking swaps between coins, not exporting exchange data early because you may lose the time period and they may not give you the data again, ignoring staking and rewards are your income, believing crypto is anonymous, no one knows and I should be okay. So it's not going to happen. Somehow they will find out. So key takeaways are most crypto transactions are taxable. Rewards and mining income are income. Good report keeping is essential. Accurate reporting is required to the tax department. Need further advice? If you need any advice with crypto tax and reporting according to you, if you need some disclosures, contact us for advice.